In this week's update, chart patterns confirm that a lot of investors still want to sell. Sentiment has overtaken the fundamentals. Is the value reset done? And the current investor's dilemma. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented in this video is of a general nature only. All right, the fascinating weeks just keep rolling on, so let's have a look at the current status of the market. And I've got to say that the downtrend, and we've got the vast majority of stocks in some form of short or medium-term downtrend, is not consistent with many of the financial results. Now, there are some stocks where their downtrends are well and truly warranted, no question at all. But there is, as inevitably as always happens in these sort of corrections, the baby gets thrown out with the bathwater, and some very, very good stocks that are now cheap are still under selling pressure because investors don't really know why they're selling, because they don't have a plan. They're just selling because of emotion. And so we've got a situation where the pressure is on to the downside, and we may well see lower prices yet. But the stocks that I'm laser focused on are the ones that don't deserve it, have got great growth outlooks, have got terrific fundamentals, and will almost certainly bounce back fairly quickly, and almost certainly before we see the lows in the index. So this sort of overshoot is not abnormal. In fact, it's pretty normal when sentiment turns south. But interestingly, the S&P is on track for the highest year-on-year earnings growth in 5 quarters. That's the reality. Now, okay, the US market had got ahead of itself, had become too expensive, and so the valuation reset that I started talking about 4 or 5 weeks ago really had to happen. And it's actually a healthy thing if you want to step back and look at it, because it'll get rid of some of that excessive froth on the top of the market and allow the really good stocks to move forward again. But to just bear that in mind when you're reading various media headlines about the market, that the corporate earnings growth rate is pretty good at this point in time. And I'll have more to say about what the Fed said shortly. Now, again, the reality is that stocks with strong fundamentals always lead the market recoveries. It's just the way that the market works. They're sold off on emotion, and they rebound when the smart buyers step in, recognizing that they're getting a bargain, and the same will happen again this time. But the key part about this is that if you leave it until the sentiment is better and prices are started going up again and you're feeling comfortable, then it's way too late, because you just can't do the amount of work to get the confidence to pull the trigger quickly. And sometimes the windows of opportunity are quite small, as in days. We can see very, very sharp moves in some stocks just in a matter of a couple of days. So now is definitely the time to prepare. You may not be buying in any meaningful amount for several weeks or several months, but you certainly need to have your plans in place. And we're already buying quite judiciously, quite carefully, but we are already buying where the justification is certainly there. Waiting until the coast is clear, till the media says it's okay to go, till the voices in your head say it's okay, time to go, it's way too late. You're just leaving far too much. And I saw some numbers the other day, which are always trotted out during these sort of periods, that if you missed the best 10 days of the last 30 years, then the impact on your portfolio is quite profound. And whilst that at first glance seems a bit unbelievable, it's true because there's been many studies done into it. So just missing a tiny, tiny fraction of the best days of the next decade or 2 decades is going to cost you dearly. So if you're looking for a reason or a need to prepare now rather than just wait and see and, play it as it comes, then that's captured right there. And over the long term, 3 or 4 or 5 percentage points difference in your long-term return is a huge amount of money when measured over 10 or 20 years. It really is massive. All right, the Fed through the week, the Fed sort of calmed markets a little bit, as we'll see shortly. They sat tight on interest rates, but they did 2 things that you would have expected would have disrupted the market. They revised the GDP down from 2.1% to 1.7%. So it's a significant economic slowdown. And they also raised the personal consumption expenditure, the PCE inflation number, which is one of their key factors that they monitor. And they revised that up from 2.5 to 2.7. So economic growth down, inflation up. You would have thought that would have been very, very nasty for the market. But in the post-conference discussion, Powell did say some things that the market liked, and that was that he felt that Trump's tariffs, any impact would be transitory. I think the market sort of seized on that and liked that, and the market's rallied a little bit anyway. So is that a sign that the valuation reset is done? Look, I don't know. To be honest, there's not enough information. Personally, I've got some views which I'll share with you when we get to the charts. Is it just a dead cat bounce that we saw for a session or two last week? That's also entirely possible. So it's still definitely a time for care. And I think there's a fair chance that the majority of the market is likely to continue in a sideways to downwards direction. So this is the investor's dilemma. What do investors do when we're at this juncture where the market may have fallen enough to turn around, but then again, it may not. There may be some new news. Trump may make some new about faces that change the sentiment and turn it significantly negative again. So what do investors do when we're in this sort of situation? And the answer is that you take advantage gradually, because as I keep saying in this video for weeks now, the best stocks will turn around first. They'll fall less to start with. They'll rebound early, well before the indices. We see this every cycle. And the best growth stocks will almost certainly trade higher than they currently are at some point in the future, and probably not that far away. Again, if you look at the studies that have been done around the indices after corrections, generally the indices are higher almost on all occasions. They're higher within 3 months, 6 months, and certainly 12 months. So if the indices are higher, just think how the best performing stocks are doing. So therefore, it's a matter of your perspective on the market. If you're buying a quality growth asset and it drops a bit further in the short term, does it really matter? Isn't what's important the value of your portfolio in 2 years, 5 years, 10 years or longer? Isn't that the only thing that's really relevant if it's your retirement savings? So this is all the perspective that's really, really important. Let me just go and highlight a couple of US stocks. So I just want to look quickly, and these aren't recommendations, of course. This is just an observation of the market. So we'll look at some of the key stocks that have been part of this valuation reset. So we'll look at Google. This may not be the ultimate lows in Google. We've come off from roughly 210 down to 165. It may not be the ultimate lows for Google, but it's now down to a level where the growth certainly justifies the current price and multiple, in my opinion. So from a long-term point of view, if an investor started accumulating Google around these prices, then the very high likelihood is that it's going to be profitable at some point in the future. Similarly with Amazon, similar sort of decline just below the 200-day moving average. There's no real signs of a turnaround at this stage, I hasten to add. But from a purely fundamental valuation point of view, the reset has almost done its work. It doesn't mean it can't get cheaper, and often they do. And Microsoft is actually looking quite worse than the other two. So the point I want to make here is that there are plenty of US small cap and mid cap stocks that have more than completed their valuation reset. And as a consequence, their PEG ratio, so their price earnings ratio relative to their growth, is significantly less than 1. Now, that's just a very rough, broad brush sort of ratio, but it's not a bad starting point. And some of them are trading on ratios that are less than a half. So there is certainly some fundamental value there. Now, that doesn't make share prices go up in the short to medium term, but it generally does in the longer term. And similarly in Australia, we're seeing plenty of great growth stocks, my favourite stocks that I've got really high conviction about because I've done the research work. And they're generally founder-led businesses across the spectrum, whether it be in technology, in mining, in healthcare, communications, whatever it might be. There are some absolutely fabulous founder-led businesses in Australia. Now, most of them are under price pressure at the moment, and that's normal, but they will rebound. There's a bit of a perspective on the markets and what to do at this point in time, because it is a very tricky period where the market may or may not go lower from here. So what do you do to get prepared? Because the buying opportunities are absolutely inevitable when they eventually appear. So to assist investors with that, we're making a short-term offer to take advantage of the Insiders Club, which is our flagship membership. We're offering a $100 discount to the normal rate for the first month only. So it will be $149 is the discounted rate. You'll have a direct line of communication to me to help prepare your plan, just to get your thoughts sorted, get an accurate perspective on the market. Specifically, gain clarity over the style of stocks that should form the bulk of your portfolio. And that's a very individual decision, but there is a thinking process that can help you through that. And ultimately, the recommendations made in the Insiders Club are highly specific. There is a link below this video to that offer for anyone that's interested. And also, if you like to go onto our website, we've got a strong track record. It's taken a little bit of a dent in the last 4 weeks, as you would expect, but there is a scoreboard there that shows in our core portfolios the performance over the last couple of years. Okay, next point. This is a tricky market. This makes it even more critical that you've thought through and sought the advice that you need, be it financial, legal, or any other advice before taking action. But the one thing that you can do is get a plan, get prepared, and be positioned for the inevitable rebound that will come. Let's look at the American market now. The S&P rose 0.5% for the week. The NASDAQ by 0.25%, so they weren't big gains. The Russell for small caps, 0.4, and the equal weight S&P slightly better at 0.7. So it was a little bit, it wasn't much. It looks and feels more like a dead cat bounce than anything else, but who knows? Some dovish comments from Jeremy Powell arrested the slide that we saw in the market. What would a bit of an about face from Trump on tariffs, what would that do to the market? I'm not saying it will happen, but it's possible. And that's why getting prepared, and if there are bargains available to be taken right now to start judiciously buying them, then why not? Most sectors last week finished positive, most of the 11 sectors for the US. Tech and staples were mildly lower. They were the only two, which is an interesting combination. Technology, the most aggressive sector, and staples, just about the most defensive sector, were mildly lower for the week. And over the last 4 weeks, and this is a surprisingly big number, technology and consumer discretionary sectors, so 2 of the 11 sectors, contributed 61% of the decline in the S&P. Now, okay, obviously the Magnificent Seven has a massive impact on the overall index, and about 40% of that 61% decline was due to technology and therefore heavily the Amazons and the Googles of the world. But it just shows that a lot of that valuation reset has occurred. Will it overshoot? That's really the question at this point in time. And the US dollar managed to edge very slightly higher to just over 104. The yield was slightly lower, down from about 4.3 down to 4.26, and the VIX also eased off from around 21 down to 19. Let's go and look at some of the key charts. We'll start with the NASDAQ. So there's the NASDAQ on a weekly chart. You can see we had 4 significant weeks to the downside before a bit of a reversal late the previous week. And then we got a much smaller range candle. So the market settled down quite a bit. And you'd have to say that is quite an indecisive candle. Now, if this is only a shorter term pullback, then these 2 candles are indicating a level of indecision that could be a low. I don't assign a high probability to that. I think there is a much higher probability that we're going to get a correction that lasts longer and goes deeper at the index level, I stress, not necessarily at an individual stock level. So that's the NASDAQ. If we look at the S&P, and this is on a daily chart, you can see the nature of the bounce. There's lots of long wicks on the tops of these candles, and the candles are not really very emphatic, except the red ones, of course. They're probably the most emphatic candles in that view. So you can't look at that chart and say that the buyers are back in control, because they just aren't. Every time the market pops its head up a little bit, there's another little wave of selling comes out intraday to knock it back down again. So there's nothing particularly positive that you can hang your hat on with that chart. And if we go back to a couple of the ratio charts that I'm watching very closely at the moment, this is the S&P 500 versus gold. We're at a very critical level in terms of the way the market sees risk and reward. This chart is saying that the S&P 500 has done far worse than gold, which of course everybody knows who watches the market. But seeing it in this graphical form, and the fact that I don't think it's coincidental that we're back to the levels December 2018, when Trump was last rolling out his tariffs and causing disruption, August 2019. So I don't think it's coincidental that we're back at this same particular level. And the other ratio chart that's also critical is consumer discretionary versus consumer staples. And despite the fact that consumer staples was a pretty ordinary performer last week, this really didn't bounce very much. So that is still looking rather negative at this point in time. So overall, my view is the indices haven't found a bottom yet. I think that's the higher probability, not a prediction. I just work with probabilities based on what this market action is telling me. These are not my ideas. This is what the money flows in the market are saying if you take the time to learn how to read them. But I do think that there are some stocks that are already on the move, particularly in Australia, some stocks that I've been very keen on for a number of years, and they're actually moving quite positively. So that's the key thing. Where are the opportunities at the moment? Now, if we look at the currencies, this is the US dollar index, the slightest of bounces, but look, it's really nothing much at this point in time. And the Aussie dollar finished pretty much level where it was the previous week. So let's go and look at those at the Australian market. So just over 62 was where our dollar finished. There is a key level at 61.3, so we're not very far away. We're less than a cent away from a key support level. And you can only look at that chart and say that it's more likely that that key support level is going to break. And that would send the Australian dollar down under 60 cents. The Aussie index was up 1.85% for the week. So that was mainly a bounce back in banks and also in the energy sector. We've got high PE stocks that remain under considerable pressure. These are the market darlings. Their market darlings generally justified. It's just they went too far and the valuations became really excessive. And those sort of valuations are now being reset. But have those businesses changed one little bit? No. They are still great businesses. And at some point in the future, it's likely that they're going to rebound and set new highs. But when that time is, remains to be seen. but the businesses are going along very nicely. So this is where clarity of purpose is really essential. You've got to know why you own something and what is the time period and what is your expectation around that particular stock. And unless you know why you own something, then how can you make decisions about buying or selling? It's just crazy. There are also plenty of trading ranges as well. In fact, the vast majority of good stocks that I follow are in a trading range. There's a few that are going up, there's a few that are going down, but most of them are in a trading range, which is actually a pretty good statement. Stocks that are holding up in this kind of environment. But it remains a nervous and rather uncertain market, that's for sure. Precious metals. Gold up another $49 and has closed above $3,000 on a weekly basis at $3,024. So that's a real milestone. In Australian dollars, a whopping 48.20. So very profitable territory for Australian miners. Silver, a bit of a minor slip to just under 34. Silver has got some significant overhead resistance to clear around 35, 35 and a half. But after that, we could see a significant surge in silver. There was some profit taking on Friday, as we'll see, into this rally in gold, and that's not at all abnormal. And it's actually quite healthy. And the local miners was a very powerful week for the Australian gold stocks. So let's go and look at those charts. Start first of all with the silver chart. So this is a daily chart. You can see there was a bit of a dip on Friday, but did manage to close quite comfortably off the lows on Friday. But silver really needs to get up here above $35 to establish some new highs and ultimately to have a crack at moving back to $50, which were $50, which was the highs back in 2011. There's the US dollar gold price on a weekly chart. So you can see there was definitely some selling at the end of the week, but it's a very, very powerful trend. And there's the daily chart, which shows a little bit of intraday selling into that rally, but that rally had gone quite well for a number of sessions. So this is actually quite healthy. And there's the Australian dollar gold price to finish with. And just for those that are interested, this is the Bitcoin chart finished at just over 84,000. And if we look at GDX, the Australian listed ETF, had a very good week. It's a weekly chart. So the last 2 or 3 weeks have been particularly strong. So they're the way that most of the markets sit. Commodities, copper has gone above $5. Nickel at $7.38. The copper market is temporarily right out of balance, and that's why the copper price has gone up above $5. So the key question for the copper market is this just a transient spike to the upside that will reverse itself? That's possible. It's been caused by, obviously, the impacts of tariffs and all the uncertainties. It's also almost certainly created by some short covering. So people that were short the copper market have now joined the buy side, and that helps increase the buy side demand. And there's also some seasonal factors around the production of copper from Chile, which is the world's biggest producer, that are contributing as well. So there is definitely some shorter term transient features. There are some other features that may or may not be transient. So we've got uncertainty very much in the copper market, but at the moment it's favouring the positive side. So a little bit tricky with copper, as with many other things. But again, if you're interested and looking to get exposure to the copper market, you really need to be taking a longer term view. Large short-term bets at the moment are pretty unwise because the situation is so unpredictable across just about all asset classes. West Texas Intermediate crude was up slightly to 68 on renewed tensions in the Middle East, as you would expect. There's the spot copper chart, so quite a big surge and we're now back at the levels that we were in May of last year. So it's been a very, very steep rise from the start of the year from $4. So the copper market is up in excess of 25%, which is a pretty big move. And there's the crude oil chart. It's been in a long-term downtrend, really, over the last year. If you go back to April, May last year, we were trading at 85, and we've just set lower highs and lower lows throughout, but a little bit of a turn. And this is a pretty important level here, around this sort of 65, 67 mark. Very important support level for crude oil. So wrapping things up, it may be okay to start looking at nibbling depending on your psychology and your game plan. The one thing that I wouldn't do is to just leave the decision and say, well, I'll think about it when the news headlines get a bit better. I think that's the one thing you shouldn't do. The but for me is that you need to restrict your view to only the high conviction stocks that you're prepared to be in for the longer term. If you restrict your view just to those high conviction stocks, then you may or may not pick the bottom in the stock, but it doesn't really matter, to be honest, because if the stock price is going to be significantly higher in 3 or 5 years' time, then what does it matter? Only buying portions to a clearly defined plan, and that clearly defined plan obviously bounces off your psychology very heavily. It's just the way that you need to do it. Be clear on how much cash you still want to hold at this point in time. So if you have cashed up to a degree, there is still uncertainty out there. There is still a lot of nervousness in the market, and there is still a probability that we'll see some cheaper prices. So be clear about how much cash you want to hold. Don't have a fear that you're going to miss out on the next rally, because I'm not sure that that's terribly likely either. And be prepared to look through the volatility. That's the most important thing. There is no way in this sort of environment, this unpredictable environment, that we can be sure that we're getting the bottom. So accumulate progressively. And the key is to have conviction in the assets that you're buying. You can't afford to be making guesses at this point in time. You need high conviction. And if you don't have that high conviction, which I would expect applies to most investors, because they just don't have the time or the interest to do the research work to get it, then you need to find that conviction by other means. Portfolio Analyst this week coming. It's very much about helping members to get conviction. What are the factors that make a really high conviction buy? That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.